Let's discuss the first question in tutorial 11. So in this question, we will be calculating the cost of equity. So the question is that stock in Meta Limited. This company has a beta of 90.90. The market risk premium is 7%. The T-bill are currently yielding 4%. So this company's most recent dividend was 1.90 per share, and dividends are expected to grow at a 5% annual rate. So if the stock sells $40 per share, that means if the share price is $40, then what is your best estimate of March's cost of equity? So question is, after giving as all the information are given, so we need to calculate the cost of equity. So all those informations on the the information on beta, the description on beta and the market risk premium, everything are in the lecture slides, and I believe that you have already gone through the lecture slides, so you should have knowledge about these. But I would like to tell you a little bit about the beta and other things. Beta is the risk of this company. So beta can be 1, beta can be more than 1, beta can be less than 1. The market risk premium is simply the market rate minus the risk-free rate. So let's say that in the market, if you invest in government bonds, which is considered as a risk-free rate, let's say in the government bond pays approximately 4%. So 4% return. So your risk-free return is 4%. And let's say if in the company, on average in the market, on average the company pays 9%. If you invest in a company, then you get 9% return. So that's the market rate. So market rate in this case is 9%. So your risk premium is market rate minus the risk-free rate. That means 9 minus 4, then you get 5. Your 5 is the risk premium. The risk premium means that what extra interest rate you are getting to take extra risk, because if you invest in other companies apart from government bonds or government securities, then there are some sorts of risk attached. Some company is less risky, some company is more risky. So remember, in finance we always say that more risk, more return. Higher risk, higher return, right? So if you invest in government securities, which is less risky, you get less return. If you invest in private companies or public companies, sorry, if you invest in public companies where it is a bit more riskier than the government securities, then because you are taking some extra risk, you will get some extra return. That's called the risk premium. T-bill. T-bill is the government bills or the government securities. Let's say Malaysian government sells bond. So those are called T-bill. And dividend and growth rate, those are very easy to, very simple. I believe you know already. So let's answer the question. So there are two ways of calculating the cost of equity. One is using the CAPM model, another one is using the DGM model. So question is, which one should I use? Answer is that you will use those equation which information are given in the question. Let's say if the question gives you information about the risk-free rate, about the beta, about the market rate, risk-free rate, or about the risk premium, then you can use the CAPM model to calculate the cost of equity. However, if the question gives you information about the dividend, next year's dividend, next year's dividend, growth rate, today's price, this kind of things, then you know that you can use the DGM model to calculate the cost of equity. So in our question provides the information for both models. So we will calculate the cost of equity using both models and then find the average. Very simple. So first we will use the CAPM model. So CAPM model is simply the return on equity equal to risk-free rate plus beta and then times RM, means a market rate minus a risk-free rate. So sometimes in the question you will be given market rate and risk rate, you just calculate it. Sometimes the question will say the risk premium is this. Risk premium simply means RM minus RF. So this is called risk premium. So in our question, it says the risk premium is 7%. That means the difference between the RM and RF is 7%. So if you plug those numbers in, you will get this, that 4% is the risk-free rate, 0.90 is the beta, and 0.07 is the risk premium. If you solve this equation, you will end up with this answer. So using CAPM model, our cost of equity is 10%, 10.30%. Now, if we use a DGM model, this is the equation. RE means return on equity, and then D0 means today's dividend, and 1 plus G is the growth rate, and then divided by P0 is the today's price for the share, and the growth rate is what's the growth rate. So all are given in the question. If you plug those numbers in, you will get this equation. If you solve it, you will get 9.99. So as you can see that the cost of equity is slightly different between them two. So all we will do, we will average them to find out the rate, the return on equity or the cost of equity. So in our question, and the cost of equity is 10.14%. Thank you.